Welcome to this explainer on HEICO Corporation, where we're going to unpack the record-breaking Q2 2026 financials and dissect the market valuation behind this absolute powerhouse in aerospace and defense. Now, if you've been keeping tabs on the industrial sector lately, you already know HEICO has been making some serious waves. Today, we're cutting straight through the noise and looking strictly at the data to understand exactly how they're engineering this incredible growth. Okay, here's our roadmap for today. We'll start by looking inside HEICO Corporation, then break down their twin growth engines, dig into those record Q2 2026 profits, check out how debt and strategic acquisitions fit into the picture, and finally wrap things up with their market valuation and M&A activity. Let's get right into it. Section 1. Inside HEICO Corporation, a quick look at the company overview and its leadership. So to really understand HEICO, we have to look at how they operate and, importantly, who's actually at the helm. Under the guidance of co-chairman and co-CEOs Eric and Victor Mendelsohn, HEICO runs a highly successful decentralized model. This is key because it basically prevents corporate bottlenecking, right? It lets them maintain this laser focus on long-term value and highly selective mission-critical acquisitions across aerospace, defense, and electronics. And what's actually driving the business forward? Well, their demand is fundamentally propped up by some massive long-term industry trends. We're talking about heavy commercial fleet utilization, a huge demand for aircraft maintenance, global defense modernization, and just the sheer increasing complexity of space and electronic systems. But, we do have to remember they don't operate in a vacuum. They are absolutely still exposed to the cyclical nature of airline profitability and shifting government defense budgets. Moving right along to Section 2, the twin growth engines, FSG versus ETG. This is where it gets really interesting. Let's look under the hood at how the company actually pulls in its revenue. They basically split their operations into two distinct, high-performing groups. On one side, you have the Flight Support Group, or FSG, which handles critical replacement parts. These guys are adding a staggering 300 to 500 new FAA-approved parts to their catalog every single year. Then, on the flip side, you have the Electronic Technologies Group, the ETG. They're out there creating advanced, mission-critical electronic subcomponents for massive defense and space systems. And looking at this really illustrates their incredible reach. HEICO isn't just relying on one type of buyer. Their customer base is wildly diverse. I mean, they are selling everything from cost-effective replacement parts for commercial airlines and cargo carriers, all the way to underwater locator beacons and high-speed power conversions for the military and top-tier defense contractors. They're deeply embedded in the supply chains of both commercial aviation and defense logistics. All right, let's get into the numbers. Section 3. Q2 2026, record profits. Unpacking the financial surge. Jumping into their latest earnings release, the absolute standout figure for Q 2026 is this massive 49% surge in net income. They hit a record $233.8 million. Think about that for a second. In an environment where so many industrial players are getting crushed by supply chain costs, posting nearly 50% bottom line growth is just staggering. Now, that net income leap didn't just happen by magic. It was directly fueled by a 41% jump in operating income, hitting a record $350.4 million for the quarter. Both the FSG and the ETG segments contributed heavily to this massive surge in profitability. And driving all of this bottom-line success, incredible top-line growth. They saw a 25% increase in net sales, generating a record $1.37 billion for the second quarter alone. We are literally looking at a company firing on all cylinders across its entire product lineup. But honestly, the crucial point here isn't just that their sales went up, it's that their profitability fundamentally improved as they scaled. Check this out. Consolidated operating margins expanded from 22.6% in Q2 of 2025 up to a super healthy 25.5% in Q2 of 2026. Management is attributing this margin expansion to a really favorable product mix, especially in those aftermarket parts, as well as some excellent SG&A efficiencies. Basically, they are controlling their administrative costs beautifully, even as their revenue skyrockets. But growth like that usually comes with a price tag. Section 4. Debt and strategic acquisitions. Funding the growth. As any seasoned investor knows, rapid, record-breaking growth requires serious capital. If we look at their balance sheet, total assets jumped by over $1 billion in just a 6-month window, from $8.5 billion to nearly $9.6 billion. Notice where that growth is primarily coming from, though. It's driven by a roughly $500 million increase in goodwill and a corresponding $400+ million increase in long-term debt. Consequently, we're seeing their leverage tick up. Their total debt to net income ratio rose to 3.28 times, and their net debt to EBITDA ratio nudged up to 1.74 times. Now, this leverage was taken on intentionally to fund 4 recent strategic acquisitions, 2 for the Flight Support Group and 2 for the Electronic Technologies Group. Management has been pretty vocal that their capital allocation remains opportunistic but disciplined, focusing on accretive deals while keeping their financial flexibility intact. Which naturally begs a pretty critical question, one recently highlighted by analysts over at Pinify. Can HEICO's management actually maintain their historical operational discipline as they take on more and more debt to fuel this ongoing M&A spree? As the company gets larger and more complex, successfully integrating these new acquisitions without sacrificing those beautiful 25% operating margins, well, that's going to be the ultimate test for the Mendelsohn leadership team. So what does the market think about their chances? Section 5. Market valuation and M&A. Pricing the premium. To understand if the market actually believes they can pull this off, we just have to look at the McLean Group's Q2 2026 M&A Insider Report. HEICO is currently priced for absolute perfection, commanding a towering 9.0 times trailing 12-month revenue multiple. Just to put that into perspective, the defense industry's median right now is sitting at just 2.0 times. HEICO is quite literally leading the pack in terms of valuation multiples among publicly traded aerospace and defense companies. Of course, in the eyes of investors, this massive premium valuation is clearly justified by their aggressive organic and acquisition-based growth rates. Look at these year-over-year revenue leaps, nearly 35% growth for the Electronic Technologies Group's external customers and over 21% for the Flight Support Group. The market is happily paying a premium today for what they firmly believe will be a much larger, highly profitable company tomorrow. Which leaves us with a final provocative thought to wrap up this explainer. In an industry that is notoriously dependent on the cyclical whims of government defense budgets and commercial flight hours, can HEICO's record-breaking momentum actually continue to justify its premium market price? The numbers today look phenomenal, for sure, but at a 9.0x revenue multiple, the pressure is undoubtedly on to ensure that every new acquisition and every new product line delivers absolute perfection. Thanks so much for joining me as we unpack the data today. And keep exploring these numbers to see where HEICO flies next.